All right. Thank you for clicking on the play button. This is your host, Marcus Monero here. And I know it's been a long time. And first of all, I wish you all a happy new year. This is the first episode for 2022 for the Finfluential. And I got a special guest. He's not in the cryptos. He's not in the blockchain, but he's the real deal. Solid gold bars all the way through. So I have David Garofalo. I hope I pronounced the name correctly.
Very close, Garofalo. Very close, though.
Garofalo. Okay, all right. And he's from the Gold Royalty Corp, and he has a long history when it comes to investing in precious metals and base metals as well. So we're just going to kind of have him educate us on what are the fundamentals to invest in the precious metals industry, and also share some insight on the current economic situation. So before I continue yapping, I would love for you to introduce yourself and tell us something interesting, and we'll take it from there.
Sure, Marcus. Thank you so much for having me on as a guest. And I guess my history is more on the mine building and production side. I've been in the business for over 30 years and spent equal amounts of time building base metal mines, copper, zinc, and precious metal mines. And over my career, I've been involved in the construction of 15 mines across the world, operated countless more in various capacities. Most recently, before I launched this royalty vehicle, I was the CEO of Gold Corp, one of the largest gold producers in the world, which merged with Newmont to create the world's largest gold mining company in the world. Before that, I was running High Bay Minerals on the base metal side, which is still a large cap copper producer based in Canada. And then before that, I was with Agnico Eagle Mines, one of the largest gold producers in the world as well, where I was the CFO for 12 years. So I do come from a more operating and mine development side. But I've entered now into the royalty business, which is to say we're actually writing royalties on producing and development stage gold mines and taking top line exposure and getting that exposure to the gold price, but insulating our investors from cost risk. And we are in an inflationary environment, as you well know. And so providing that leverage to the gold price while insulating our investors from inflation risk is really what's behind our investment thesis on the royalty side.
Oh, wow. Okay. That's a lot of great info. I understand here you have built businesses, and I'm just quite impressed, especially, during my university days. I have read a lot of info about many people who are in the precious metals mining industry, also the junior producers. I'm sure these are pretty common terms for you, but for me, learning about how they got into this industry, there's a lot of regulations, a lot of operating procedures. Could you just kind of give us a brief overview of how complex it is? I know a lot of people take it quite simple. It's just you just find places, extract, and that's it. But I'm sure there's more. It's more complex, right?
Certainly, from discovery of a new deposit to actual first production typically is 15 to 20 years. It's a long lead time to new development. And that's really why I think the investment thesis for gold is so strong right now. In addition to this low interest rate environment, in fact, negative interest rate environment on a real basis, which is driving demand for gold, supply is heavily constrained by the lack of new exploration activity over the last half a dozen years, as companies have focused on harvesting returns from their existing assets and have not reinvested in exploration. But also the regulatory environment has become so much more complex than it has been historically. Multi-stakeholder engagement is extremely important to building new mines, which means you have to get social engagement with the local communities, buy-in. You have to go through a regulatory process, not to mention that you have to define these deposits geologically. You have to make a case for them. You have to engineer and make an investment case for these opportunities before you even put a dollar in the ground of any significance. So you can imagine how complex it is to get new deposits up and running. And that's why over the last half a dozen years, we've seen a 40% decrease in gold reserves in the ground globally because the industry has not been reinvesting back into exploration in a meaningful way because of those complexities, those impediments to exploring and developing. And so now we're at peak gold supply. We're seeing supply decline. If reserves are in the ground are declining, and invariably, inevitably, production has to decline. So we're probably in a 10-year plus horizon where we're going to see supply significantly constrained and declining, which really helps underpin the investment thesis in gold.
Okay, so is it just gold, or what about, like, other metals, like say silver, for example? Because me and some of the people who I follow, with, we have this a fascination with silver because it's affordable. But correct me if I'm wrong. I think after oil, silver is the most used metal or commodity in terms of industrial use and other applications.
It certainly has more industrial utility than gold. Gold is typically used as a store of value. It's in the reserves of central banks. It's around people's wrists and fingers. And silver is quite often used in industrial applications. But my investment thesis for gold, or silver, I should say, is exceedingly strong, equally as strong as it is for gold. In fact, more so, because typically the gold price to silver price ratio in a bull market is close to 40-1. Today, it's between 70 and 80-1. And so we've seen silver underperform gold as gold has gone up over the last 6 or 7 years. And so what will happen as gold starts to gallop, people will treat silver as a proxy for gold. And you'll start to see that ratio narrow, and the silver price will vastly outperform. My theory is that gold will probably achieve at least $3,000 an ounce in this cycle, because that's the real all-time high in gold. Because if you go back to 1981 dollars, when we last had a hyperinflationary cycle, gold achieved about $850 an ounce in 1981 dollars. Today, that would be about $3,000 an ounce. So if you believe gold's going to $3,000 an ounce, it will gallop to that. And I think we are going to see a violent upward movement in gold in response to these low interest rates and whatnot. Silver has the potential to go north of $100 an ounce as that ratio starts to narrow to what you typically see in a bull cycle in the precious metals business.
Interesting. Yeah, because I like what you mentioned about. I guess I was a little shocked about the discovery of gold underground in terms of exploration. So, if that continues, I'm assuming that I'm assuming the prices for gold or any other precious metals will be going up. But also on top of that too, I'm assuming there's also going to be a lot of industrial demand as we are entering a phase of, I don't know how do you call it, like the ESG phase, like everyone's trying to get into electric vehicles. There's also demand. Now we're talking about biofuels and all that, but electric vehicles for sure, or renewables. Wouldn't that kind of put a lot of increase the demand for precious metals?
I would say for commodities generally. For example, electric vehicles have 3 times the amount of copper in them than a traditional internal combustion engine. And so the intensity of metal consumption will only go up as the economy becomes more electrified. And so I think that phenomenon that I was talking about in the gold business, underinvestment in exploration and development, is not unique to precious metals. It's quite prevalent across all the commodity complex because we've gone through 6 or 7 years of relatively flat prices. There hasn't been the incentive for the producers to reinvest back into exploration in a meaningful way. The junior market's been largely closed off from the capital market, so they haven't been able to access capital to do the grassroots exploration that's so vital and existentially important to the mining business. So we're in a period of significant underinvestment. We're just coming out of that. I think we're going to start to see a pickup in exploration as we see commodity prices pick up. But we're not going to see the benefit of that exploration for many years to come because, as I said, it's typically 15 to 20 years from discovery to first production. So that downward trajectory in supply across the commodity complex is here to stay for at least a decade.
Okay. Yeah. No, I mean, that's a lot of info to digest, but because I'm just thinking about just the ramifications and stuff. So I'm sure later on, I guess in the current, I would say the business news cycle with CNBC, they all talk about, the stock markets and cryptos, all that. But I do personally believe that, gold and precious metals will have their heyday, like their limelight. But I was just kind of curious to ask you about, because I know you have dealt with some government officials. So I guess with governments, like, how would they, I guess, view gold, I guess in the light of, dealing with central banks and, other, I guess, federal governments or world governments, like, what do you think is their viewpoint when it comes to like metals like gold and silver?
So they're net buyers. Central banks globally are net buyers of gold, significant net buyers of gold right now, because there's no opportunity cost to owning gold. So if you go back to the late 1990s, gold was about $250 an ounce. Interest rates were considerably higher, both on a nominal and real basis. Inflation had been tamed, and interest rates were 7-8% on U.S. Treasuries, for example. So quite often there were central banks that were selling their gold reserves and buying U.S. Treasuries because there was yield in Treasuries. There's no yield in gold. But today, even though gold continues to yield zero, the reality is Treasuries yield negative on a real basis, given where inflation is. Treasuries are paying under 1%. Inflation's 7%. Right. 40 years high. So basically, by owning treasuries, you're eroding your capital. And gold protects you against that. Gold is the one currency you can't print. It has a very finite amount of supply. In fact, if you took all the gold that has ever been mined since the beginning of time, it's about 200,000 metric tons, which may sound like a lot, but just to give you a visual, you could fit that into 4 Olympic-sized swimming pools. That's it. It's a very, very finite supply. And we're only adding, only adding 4,000 tons a year from mine supply. So about 5% to supply per annum. And that supply is declining. And it's not something that has a high elasticity to price. So if gold went to $3,000 an ounce tomorrow, it's not like this industry can flick on a switch. We're already at 97, 98% of capacity. We have no new capacity to add on in response to price. And as I said, the lead time from discovery to first production is 15 to 20 years. So there's a remarkable inelasticity of supply to price. So, the industry will not respond to a higher gold price in terms of increased supply. And so, again, it's a very finite supply. So as capital inevitably gets allocated to what has been a reserve currency for 4,000 years, because of the low interest rate environment and the erosion of capital through inflation, I think that you're going to see a very violent upwards move in the gold price.
Yeah, first of all, I'm so glad you talked about the treasury bonds, the value, how it's eroding. I think eventually I can see, a lot of value would go to gold and silver, and also I guess a lot of the, I'm assuming like the big pension funds, I know they invest a lot of money into treasury bonds and stuff. So eventually they'll be like, questioning too, right? Like, wait a minute, like, the inflation is going to start eating up, and, so I know a lot of big corporations too, they are trying to get rid of cash. I guess in the words of Ray Dalio, right? I think he has this, I know it's kind of like a very weird statement. Cash is trash, but not in the, I know there's I guess the method or there's a meaning behind it, but I mean, just for my audience, I'm sure you understood what he meant, but could you kind of like break it down for us, like what do you mean by that?
Yeah, look. The way I would put it is gold supply is extremely finite, as I've tried to demonstrate in terms of the volumetric.
Sure.
Very tiny. Paper is infinite, and that's what the central banks globally have demonstrated. It's a race to the bottom in terms of debasing their fiat currencies in order to preserve their export markets, in order to stimulate economy, in order to inflate their way out of massive amounts of debt that they've strapped on. There's no fiscally responsible way for them to tax their way out of debt. They would just destroy the economy. So they're going to inflate their way out of debt and debase the underlying currency in order to do that. Well, gold is the one currency you can't debase. You can't print it. It's unprintable. It's very difficult to mine, as I've clearly demonstrated. The supply is declining in the face of a higher gold price. The supply is continuing to systematically decline. And so really the question you have to ask yourself as an investor is, how do I play the precious metal space? How do I get the most effective leverage to the gold price? And you pointed to the fact that pension funds must be questioning, what would happen to their capital bases in an inflationary environment. Well, pension funds now have an option. They can play the gold market. 20 years ago, they couldn't buy commodities, but now there's an ETF on the New York Stock Exchange physically backed by gold called the GLD. So now you have pension funds and mutual funds able to buy physical gold because there's a security traded on the New York Stock Exchange, among other exchanges or other ETFs globally. But I would say that as an investor, if you want to get optimum leverage to the gold price, I think you could also look at producers. Producers provide increasing profitability as the gold price goes up. But of course, producers are exposed to inflation as well. Operating costs and capital costs will inflate along with inflation in the general economy. And so that undermines that leverage proposition. I would argue that the royalty space is the best possible place to play gold because it provides you leverage to the gold price and it completely insulates you from inflation because it's just top line exposure. It's a percentage of no margins. So the margins can go up and down. Our exposure is entirely confined to the top line. And so it provides you that optimum leverage. And not only that, it provides you exposure to exploration upside because those royalties are in the entire property, not just on the existing reserves. So as the companies explore and grow their deposits, we get the upside on the exploration side as well. So it's really providing the best of all worlds. And that's how I see how to optimally play the gold price in a rising gold price environment we expect over the coming months and years.
Interesting. All right. No, I'm just curious, say, for example, if people wanted to, invest in producers or royalty companies like the Gold Royalty Corp, could you, break down the steps? Is it only just for American investors or are you also open to the global markets or,
We're traded on the New York Stock Exchange under the symbol GROY. And so anybody can buy our stock globally. We're open. We have investors across the globe, and it's a very liquid stock. We're trading $3 to $5 million US per day on the New York Stock Exchange, so a relatively liquid stock. We're about a $700 million market company, and we've gone from IPO last March, where we raised $200 million or $90 million and got a post-money valuation of $200, and through the acquisition of some of our peer companies, we've effectively quadrupled our size. And not only that, today we announced that we're introducing an inaugural quarterly dividend, and we're yielding close to 1% as a result of that dividend. So you're getting the best of all worlds. You're getting that exposure to the gold price. You're getting a yield on the stock as well. And you're in a vehicle with a very deep management team as well, with a long history. In addition to myself, there's about 400 years of collective mining experience on my board and management. So that provides a lot of technical depth, a lot of knowledge and access in the industry, so we can continue to grow our business very, very quickly.
Oh, wow. Okay. That was really interesting to, so for people like us, most folks, I guess, in the millennials or older generation, we tend to buy, growth stocks, but there's never been this condition for us where, we buy kind of like your defensive stocks, where, they have, a steady value. Sometimes they give dividends and stuff, but this one, you kind of designed Gold Royalty and it has multiple focuses. I think that's interesting. So, but I was just kind of curious to know about if you could explain us maybe I guess the right would be the business model behind it. Just kind of, I'm not sure how complex it is, but just kind of break it down for us.
Well, the royalty business is very simple. We raise capital in the equity markets, debt markets, and then we put that to work in the development and expansion of new and existing mines. So we provide a source of capital for the miners, the producers, and developers on a much more cost-effective basis they can otherwise access themselves in the general equity markets, because their valuations quite typically are very depressed because of the development associated with those projects. When we provide that capital to help them develop and expand their mines, we take a royalty back in return. And that royalty is perpetual. It provides an annuity for many, many decades in the case of many of our deposits. And I'll give you a couple of examples. We have a royalty in Canada's biggest producing gold mine, Canadian Malartic, in northwestern Quebec. And that mine has 30 to 40 years of reserves ahead of it. So that provides a meaningful annuity for our shareholders. And we also have a royalty on the underground extension of one of the largest producing gold mines, Goldstrike, which is operated by Barrick and Newmont in Nevada. And so, again, a multi-decade royalty opportunity for our shareholders. And that really underpins our cash flow and underpins our ability to pay dividends and continue to grow that dividend over time as the gold price goes up and those reserves are extended and grown. And we have collectively over 190 royalties in our portfolio. So it's a broad base of exposure from early stage exploration opportunities to producing assets. We have 6 producing mines that generate cash flow today and royalties today. We have 7 in construction that will produce royalty growth for the coming years. And then we have, again, a broad array of assets beyond that in different points of the life cycle that provide us a lot of organic growth internally. And so that's been the key to our success and the key to the growth in our cash flow and dividends in the long term.
Wow. Okay. No, because I'm kind of a little blown away because you guys have a lot of, because I remember you guys have a lot of operations, not just in North America, also in Central America and also South America too.
Yeah.
And you still have more mines coming into operation, I guess.
Yeah, it is America's focused. You're right. We have 100% of our royalties in Americas, but 75% of the underlying value of our business is in 2 principal jurisdictions, Quebec and Nevada. And Quebec and Nevada are rated by the Fraser Institute here in Canada, which is an economic think tank, as the 2 best jurisdictions in the world in which to operate because they provide significant geological prospectivity, low political risk, and low regulatory risk. And so those are 2 of the most prolific gold districts in the world. And we have 75% of the value of our business tied up in them. But in a very well-diversified portfolio, as I said, we have 190 royalties in the portfolio. So we provide broad-based exposure to precious metals. And over 90% of our royalties are in gold.
Wow. Okay. All right. This kind of like, changed my mind, like, kind of changed my view with regards to the mining industry. I mean, it's not like I'm like a deep expert in it, but never realized, like, you know, I guess personally for me, I always felt like the mining industry is sort of what's the right word? An open secret in many ways. You know, I know, but it doesn't get a lot of, I guess, media attention. But there is a lot of, I guess, hidden opportunities, and also not many people realize there's a lot of professional management when it comes to just organizing mining and the regulations and stuff. So, I mean, first off, congratulations and kudos to you and your team. I mean, so sometimes I feel it's sort of a thankless job in many ways. I mean, do you believe that? I mean, do you agree with that? Or
well, it's a relatively small industry. In fact, if you took the market cap of all the mining companies in the world collectively, they're less than Apple in terms of market cap. And that's ironic because the world runs on metals. You know, we need metals to fly planes, drive cars, build buildings. So mining is so integral to the general economy and becoming increasingly so. As you correctly pointed out, as the economy electrifies, we need more metals. We need more copper. We need more zinc. We need all of these metals, the battery metals as well. These have become quite strategic to global economies as we look to decarbonize the economy. So mining is so integral and important to that.
Yeah, no, I can see that. No, because I'm definitely been getting reading a lot of information with regards to, I guess, ESG, environment, sustainability, and governance. I'm assuming that is kind of is sort of a big buzzword in the mining industry space.
Absolutely, and we are quite stringent in terms of the companies we will invest in and take royalties back in, and we use a very stringent ESG filter. We want to be partnered with operators that have a strong track record on the ESG side. So not only do they operate in an environmentally responsible way, but also safely. They keep their workforce safe. People don't get injured or killed on site. So we look at their environmental standards, their safety standards, their social engagement standards, because when you're mining, you're a guest in countries quite often. And so making sure that you have strong relationships with the surrounding communities and the government is absolutely prerequisite to developing new mines and sustaining those businesses over the long run, because you're there for quite often decades, and having that strong relationship will ensure that those mines continue to develop, expand, and optimize without significant impediment.
Right. Yeah. It kind of reminds me of my fiance. She was born and brought up in Ohio. So yeah, I mean, if you know Ohio, it's sort of like a blue collar state. A lot of factories, a lot of businesses are there. There's some I guess back in the old days, but now it has become sort of like ghost town. So it kind of gives me a glimpse, how businesses and the towns or the people, society kind of like interlink, in unison. So I think that's interesting to learn that. But I was just kind of curious about I guess the team. Other than you, I'm sure that you got a team of people behind Gold Royalty. Could you kind of, I guess you guys also shareholders as well, so could you kind of like elaborate on that?
Sure. Well, we were spun out of an existing development stage company called Gold Mining back in March of last year. We were royalties on. They had a dozen development stage assets in the Americas gold assets, and we were royalties on them. That formed our foundational element. There's 32 million ounces of collective resource and reserve on those dozen development stage assets. We used that as a foundation to IPO the company. And then we quickly went about merging with some of our peer companies. We acquired a company called Elite Gold, which had a number of assets, 80 plus royalties, a number of them producing. And we doubled our size because it was a merger of equals. And then very quickly after that, we conducted a three-way merger with Golden Valley and Abitibi, which gave us access to a royalty on Canada's largest producing gold mine, Canadian Malartic. And we completed that merger at the end of last year. And so effectively almost quadrupled our size as a result of those acquisitions and went to close to $700 million US market cap as a result of that, and vastly diversified our portfolio to 190. But in the course of building our company, we've assembled a very impressive board of management, including my chief development officer, who ran the mining group for Bank of America, Merrill Lynch in North America. It was 30 years in investment banking. So he's the person responsible for assembling the assets and acquiring and sourcing opportunities to continue to grow our business. On our board, we have Warren Gilman, who runs Queens Road Capital out of Hong Kong. He's a prolific natural resource investor with over 30 years of experience in the mining business. We have Amir Adnani, who founded Gold Mining, our former parent company, still collectively owns about 14% of the company. He's in the uranium space and is extremely well known and a prolific entrepreneur as well. We have Alan Hare on our board as well. Alan has almost 40 years of experience as a mineral process engineer. He's an experienced CEO in the mining business, chief operating officer, and a prolific mine builder in his own right. So if you look at that broader group, as I said, collectively, we have over 400 years of industry experience, which is extremely, and I think a key distinction relative to our peer companies, because what that gives us is a clear-eyed view of the underlying risk of the things we're investing in, because we've all been operators, we've been developers, we know how they think. We're providing capital to them now, but we can accurately assess the risk of what we're investing in. But also, given that collective experience and seniority, we have unmitigated access to any mining company in the world. And we can call up any CEO at any large cap, small cap, mid cap company and have a conversation about royalty opportunities. And that's afforded us an opportunity to grow extremely quickly. We've only been in existence for 9 months, and we're already at $700 million market cap. We've already introduced a dividend. We've already built a sustainable business with 190 very diversified royalties within our portfolio.
But not many people realize it. But I mean, your company is quite impressive. Even so, your resume, so to speak, it is a lot of experience. I mean, like all you guys have been operators. I think one gentleman said he was also in the uranium space. I mean, that itself is a whole another level. I mean, because I have met some people from Kazakhstan, so they also have some, they're also in the uranium and all that stuff. But I'm just because I'm just reading a little bit about yourself. I'm just like, wow. I mean, I don't know. I think you could. I was just kind of curious to ask you, like, have there been other competitors or in the mining space try to poach talent or poach you? Hey, you know what? Why don't you join us? Has that? I mean, has it ever happened to you?
Well, you know what I would say is that I think I'm in the right vehicle for this point in the cycle, which is to say that I think inflation is going to underpin a rise in the gold price, dramatic rise in the gold price. And I would say being back in the operating space gives me some pause because, as I said, I think that inflation will impact their input costs, their operating capital costs, and undermine their margins. And we saw that about 10 years ago in the precious metal space. And it's very instructive because we came out of the credits crisis more than 10 years ago, and the gold price went up 140% coming out of the credit crisis. It went from almost $1,000 an ounce to $2,000 an ounce coming out of that credit crisis. So gold price went up 140%. Interestingly, the producers in the industry only went up 66%. And the reason they underperformed the commodity is because we saw rapid cost inflation. There was a rush to build new mine capacity that drove up costs, input costs, capital costs, and that undermined that leverage proposition. The interesting thing, at that point of the cycle, the royalty companies went up 350%. So they outperformed the commodity almost 2.5 times. And that's because, again, they provide that top line exposure, but completely insulate their shareholders from operating and capital cost inflation. I think we're back at that point in the cycle again, because I think we're going to see a rapid rise in the gold price. And because of the underinvestment we've seen in the industry over the last half a dozen years, I think there's going to be a rush to build new mine capacity, and we're seeing that now. But against the backdrop of inflation in the general economy, which means I think we're going to see input and capital costs inflate dramatically. So I do believe that the royalty companies are going to be the best performers and provide that leverage to the gold price that investors are looking for as they contemplate gold as an asset class to invest in.
Yeah. No, that's fascinating. I remember maybe like 10 years, more than 10 years ago, after the financial meltdown, I do recollect there's a company called First Majestic. I know they're based in Mexico, if I'm correct.
Yeah, we have a royalty on one of their mines in the U.S. called Garrett Canyon. So I know First Majestic well. Yeah.
Oh, really? Okay. No, because because I remember them. I was trying to learn about. Yeah. This is in my college time, so I was trying to learn a little bit of gold mining. So First Majestic, I know they have quite a lot silver mining. So I do remember during that time, I know, correct me if I'm wrong, they did try to expand quite a lot. So it's interesting when you said that a lot of the commodity producers they perform less because of the inflation. I know there's a whole lot of economic and financial craziness going on, but honestly, I wish I could have learned about the royalty what do you say the business model earlier, because this is something they don't teach in universities. I mean, this is you have to go kind of like this lone path. You have to learn things on your own. So, but nonetheless, I'm glad that I came across you and your portfolio. So it definitely, I think I just feel it. Gold royalty is sort of like a open secret for me. So I'm sure a lot of people will be excited to learn that. But anyways, let's try to finish off with just a little bit about I know we kind of touched upon money printing and inflation, but I'm just kind of curious about I think particularly in the United States, even though my audience is kind of wide range, but thing is that like a lot of us, whether we're Indians or Emiratis or in Asia, even some of my African friends too, we're always looking at the not just the words but the action of the U.S. Federal Reserve. So I'm sure you have come across with your international colleagues. So I guess could you give us more insight about what can we expect with the money printing, or I guess what the what we can expect from from the U.S. federal government and the Federal Reserve, like the signs to look out for.
Yes, certainly. I mean, I think you're going to see continued quantitative easing. Now, the rate of quantitative easing might go down, but make no mistake, they'll continue to increase money supply and keep interest rates relatively low. Now, we're going to see some nominal increases in interest rates. The Federal Reserve will announce a number of bumps in the interest rate, maybe a quarter point here, a quarter point there. But make no mistake about it, they've let the genie out of the bottle in terms of inflation. And we're seeing inflation headline numbers of 7%. That will only go up. And the reality is true inflation is well north of that. Anybody that's tried to buy a house or put fuel in their car is paying double digit, or buying food for that matter. All the necessities of life are going up at a double digit rate, not 7%. The 7% number always belies the reality of inflation because they use this very confined basket that excludes all the things that represent the necessities of life. So regardless of what happens to nominal rates, real interest rates will continue to decline. We're decidedly in negative territory when you net out inflation. Inflation will continue to gallop. Interest rates will only go up in a very cautious manner because, as I said, the central banks are more concerned about debasing their currencies to debase the debt that they've strapped on at the government level. There's no feasible way for these governments to repay debt other than to inflate it away. And so the central banks are complicit in that. They're there to debase the currency and deflate the debt, make the debt worth less over time, to deal with massive amounts of debt that not only came on as a result of the COVID crisis, but I would say is also as a result of monetary expansion that occurred as a result of the credit crisis more than a dozen years ago, when there's a global coordinated effort to debase fiat currencies. And that's continued for over a decade. So this is not a recent phenomenon. And if you look back the last hyperinflationary cycle, I talked about gold achieving real all-time highs back then. Gold didn't really start to gallop until Paul Volcker came in and took over the Federal Reserve and started to raise interest rates. And he did that, but inflation kept galloping. It took him years to tame inflation. And so I would say that inflation will continue to gallop for the next couple of years, if not more. And that will result in real interest rates continue to decline into decidedly negative territory, which will continue to drive the gold price up.
Now, thank you so much for bringing some monetary history, but also gold history too. I think very few are familiar with Paul Volcker and the other previous Fed chairmen, and I guess, okay, so now we know what to expect, but, say advising me, millennial and other Gen Zs too, many of us are, increasing our human capital, learning new skill sets, we're earning more money. We also getting into stocks, and a lot of us are into cryptocurrencies and blockchain. But of course, the profits that we're making, I guess maybe it's I'm just asking. Maybe it's not just for my audience, but also for me as well. How would you, I guess, maybe guide us or educate us? Hey, how to? What would be the first steps we need to take to, for us to diversify into the precious metal space?
Well, as I said, there's a few ways to play the gold price. And one is you could buy physical gold. You could line up at a bank and buy the physical gold, buy coins, buy bars. And of course, you have to find a place to store it securely and some costs associated with that. But that's fine. And there's certainly investor classes will quite often do that almost exclusively because they have the means to protect that gold and store it. And the other way, as I said, is you could buy the ETFs, which are physically backed by gold and audited every quarter, and somebody visits the vaults to count the gold and make sure it's there. And again, there's some storage costs associated with that, but it's through economies of scale, given how much gold they own, those storage costs are quite often de minimis. And the other way, as I said, is to buy the producers. They provide leverage and profitability as the gold price goes up. Assuming their costs remain stable, their profitability will go up a greater percentage than the actual gold price. But unfortunately, they're exposed to inflation, and we're seeing inflation in the general economy. And look, mining producers are not immune from inflation. In fact, they're more exposed to it because of the significant amount of underinvestment that's occurred in the industry over the last half a dozen years, and there's just going to have to be some catch up for that. And then the final way, as I said, is buying a royalty company, which provides you that top line exposure, but insulates from operating costs and gives you that exploration upside. I think it's the best of all worlds. And that's why after 32 years in the business, I position myself in a royalty company as opposed to going back into the production space after building and operating mines for over 30 years.
Okay, that was interesting. No, sure. No, hey, no, thank you for that that insight. So, if we want to learn more about you and your company, how can we reach out to you?
Sure. We're our website. It's easy to remember: goldroyalty.com, and our trading symbol on the New York Stock Exchange American is GROY.
All right. Okay. Awesome. And lastly, we have young Sophia. We love to learn, about money and finance. Do you have any, book recommendations or some educational recommendations for us? So, to kind of broaden our horizon.
Well, I'm a student of history, and I tend to read historic novels or actual, books of history about wars and whatnot, and they're all instructive in terms of economies or deconstructed, reconstructed. But I have to say that regardless of what I read, in terms of history, the one constant in all of those is gold as an asset class. It's always been there. It's always been the currency of choice for millennia. And you see that in virtually in sort of common literature and pop art and music, and gold is prevalent, and it has been because it's perceived and has been perceived as a store of value for many, many centuries.
I definitely agree with you. Yeah. Even for me in the crypto space, like when we show a Bitcoin, guess what the imagery is? It's a gold coin with a B symbol, But gold definitely has. It's not an American thing or maybe like an Indian thing. This one is part of humanity, right? So. I guess I remember there's this kind of like this not a proverb was saying, like gold is for kings, silver is for gentlemen. Sorry, I couldn't think of that statement, but I remember like just the significance of how important gold is, So, but yeah, first off, thank you so much for coming into joining the Finfluential. We get to learn about money and finance, and also I think it's really impressive to see your career and your entrepreneurial streak in all these different companies, and that also in the mining space. So you definitely build that human capital. I think that's kind of a great example of how to increase your human capital in a particular space, and definitely make yourself valuable. But I know it's. I guess the simple thing I want to say is I'm really impressed. So I'm glad that I get to learn about about gold royalty and what you're doing, and also thank you for your words of wisdom. Really do appreciate it.
Well, thank you for your time today. I really appreciate you spending the time with me.
Yeah, awesome. Anyways. All right, that's it, folks. And all the details about David and his company, we will share it in the links below. All right. So y'all be good. Y'all be safe. We will talk to you soon. Bye for now.